Critical Man Pictures presents the Vorex video training series, Black Belt 4th Degree Risk Management. This section is one of the most important sections you will ever read about trading. Why is it important? Well, we are in the business of making money, and in order to make money we have to learn how to manage risk, potential losses. Ironically, this is also one of the most overlooked areas in trading. Many traders are just anxious to get right into trading with no regard of their total account size. They simply determine how much they can stomach to lose in a single trade and hit the trade button. There's a term for this type of investing. It's called gambling. When you trade without money management rules, you are in fact gambling. You're not looking at the long-term return on investment. Instead, you are only looking for that jackpot. Money management rules will not only protect you, but they'll make you very, very profitable in the long run. If you don't believe us, if you think that gambling is the way to get rich, then consider this example. People go to Las Vegas all the time to gamble their money in hopes of winning a big jackpot. And in fact, many people do win. So, how in the world are the casinos still making money if many individuals are winning jackpots? The answer is that even though the people win jackpots, in the long run, casinos are still profitable because they rake in more money from the people that don't win. This is the term "the house always wins" comes from. In truth, that casinos are just very rich statisticians. They know that in the long run, they'll be the ones making the money, not the gamblers. Even if Joe Schmo wins $20 million jackpot in a slot machine, the casinos know that there will be thousands of other gamblers who won't win the jackpot, and the money will go right back into their pockets. This is a classic example of how statisticians make money over gamblers. Even though both lose money, the statistician, or casino in this case, knows how to control its losses. Essentially, this is how money management works. If you learn how to control your losses, you have a great chance of being profitable. In the end, Forex trading is just a numbers game, meaning that you have to tilt every little factor in your favor as much as you can. In the casino, the house edge sometimes is only 5% above a player, with that 5% being the difference between being a winner and a loser. You want to be the rich statistician and not the gambler, because in the long run, you always want to be the winner. So, how do you become this rich statistician instead of the loser? Capitalization. It takes money to make money. Everybody knows that. But how much does one need to get started in trading? The answer largely depends on how are you going to approach your new startup business. First, consider how you're going to get educated. There are many different approaches to learning how to trade: classes, mentors, on your own, or any combination of the three. While there are many classes and mentors out there willing to teach Forex trading, most will charge a fee. The benefit of this route is that a well-taught class or mentor can greatly significant or shorten your learning curve and get you on your way to profitability in a much shorter time compared to doing everything yourself. The downside is the upfront cost of these programs, which can range from a few hundred to a few $1,000, depending on which program you go with. For many of these no-trading resources, cash money required to purchase these programs is simply not available. For those of you unable or unwilling to pony up the cash for education, the good news is that most of the information you need to get started can be found for free on the internet through forums, brokers, articles, websites like Critical Man. Imagine that. We should all thank Al Gore for inventing the internet. Without him, there would be no Critical Man. As long as you're disciplined and laser-focused on learning the markets, your chances of success increase exponentially. You have to be a gung-ho student. If not, you'll end up in the fucking poorhouse. Second, is your approach to the market going to require special tools such as news feeds or charting software? As a technical trader, most of the charting packages that come with your broker's trading platform are sufficient, and some are actually quite good. For those of you who need special indicators or better functionality, higher charting packages and software can start around $100 a month. Maybe you're a fundamental trader and you need the news the millisecond it's released, or even before it happens. Wouldn't that be nice? Well, instantaneous and accurate news feeds run from a few hundred to a few $1,000s per month. Again, you get a complimentary news feed from your broker, but for some, the extra second or two can be the difference between profitable and unprofitable trade. Finally, you need money, capital, funds to trade. Retail brokers offer minimum account deposits as low as $25, but that does not mean you should enter immediately. This is a capitalization mistake, which often leads to failure. Losses are part of the game, so you need to have enough capital to weather these losses. So, how much capital do you need? Let's be honest here. If you're consistent and you practice proper money management techniques, then you can probably start off with anywhere between $1,000 to $10,000 in trading capital. It's common knowledge that most businesses fail due to undercapitalization, which is especially true in the forex trading business. So if you are unable to start off with a very large capital that you can afford to lose, be patient, save up, and learn to trade the right way until you are financially ready. Drawdown versus maximum drawdown. So we know that money management will make us money in the long run, but now we need to know the other side of things. What happens if you don't use money management? Consider this example. Let's say you have $100,000 and you lose $50,000. What percentage of your account have you lost? The answer is simple, 50%. This is what traders call a drawdown. A drawdown is a reduction of one's capital after a series of losing trades. This is normally calculated by getting the difference between a relative peak in equity capital minus a relative trough. Traders normally note this draw as a percentage of their trading account. Losing streaks. In trading, we're always looking for an edge. This is the whole reason why traders develop systems. A trading system that is 70% profitable sounds like a very good edge to have. But because your trading system is 70% profitable, doesn't mean that for every 100 trades you make, you will win 7 out of every 10. Not necessarily. How do you know those 70, which 70 out of 100 will be winners? The answer is you don't. You could actually lose your first 30 trades in a row and then win the remaining 70. That would still give you a 70% profitable system, but you have to ask yourself, would you still be in the game if you lost 30 trades in a row? This is why money management is so important. No matter what system you lose, you will eventually have a losing streak. Even professional poker players who make their living through poker go through horrible losing streaks, and yet they still end up profitable. The reason is that good poker players practice money management because they know that they will not win every tournament they play. Instead, they only risk a small percentage of their total bankroll so that they can survive through those losing streaks. This is what you must do as a trader. Drawdowns are part of trading. The key to being a successful trader is coming up with a trading plan that enables you to withstand these periods of large losses, and part of your trading plan is having risk management rules in place. Only risk a small percentage of your trading bankroll so that you can survive your losing streaks. Remember that if you practice strict money management rules, you will become the casino, and in the long run, you will always win. I expect 2% of your winnings. Just kidding. In the next section, we will illustrate what happens when you use proper money management and when you don't. Here's a little illustration to show you the difference between risking a small percentage of your capital to risking a higher percentage of it. Trader risks 2% versus 10% on each trade. You can see that there's a big difference between risking 2% of your account compared to 10% of your account on a single trade. If you happen to go through a losing streak and lost 19 trades in a row, you would have went from starting $20,000 to only having $3,000 left if you risked 10%. You would have lost over 85% of your account. If you risked only 2%, you would have still had $13,000, which is only a 30% loss of your account. Of course, the last thing we want to do is lose 19 fucking trades in a row. But even if you lost 5% in a row, look at the difference between losing 10% and risking 2%. If you risked 2, you would have still had 18,500. If you risked 10, you would have had 13,000. That's less than what you would have had if you lost all 19 trades and risked only 2% of your account. The point of this illustration is that you want to set up your money management rules so that even when you do have a drawdown period, you'll still have enough capital to stay in the game. Can you imagine if you lost 85% of your account? You would have to make 566% on what you had left in order to get back to break even. The loss of capital. Here's a chart to illustrate what percentage you would have to make to break even if you were to lose a certain percentage of your account. You can see the more you lose, the harder it is to make it back to your original account size. This is all the more reason that you should do everything you can to protect your account. By now, we hope you have gotten drilled into your head you should only risk a small percentage of your account in each trade so that you can survive your losing streaks and also to avoid a large drawdown in your account. Remember, you want to be the casino, not the gambler. Another way you can increase your chances of profitability to trade is when you have the potential to make 3 times more than you are risking. If you give yourself a 3-to-1 risk-to-reward ratio, you have a significantly greater chance of ending up profitable in the long run. Take a look at this example. In this example, you can see that even if you won 50% of your trades, you would still make a profit of $10,000. Just remember that whenever you trade with a good risk-to-reward ratio, your chances of being profitable are much greater even if you have a lower winning percentage. But, and this is a big but, like JLo's behind, setting large risk-to-reward ratio comes at a price. On the surface, the concept of putting a high reward-to-risk ratio sounds good, but think about it applies to actual trade scenarios. Let's say you are a scalper and you wish to only risk 3 pips. Using a 3-to-1 reward to risk, this means you need to get 9 pips. Right off the bat, the odds are against you because you have to pay the spread. If your broker offered a 2-pip spread on euro-dollar, you'd have to gain 11 pips, instead forcing you to take a difficult 4-to-1 risk-to-reward ratio. Considering the second exchange rate, euro-dollar could move 3 pips up and down within a few seconds, and you'd be stopped out faster than you could say uncle. If you were to reduce your position size, then you could widen your stop to maintain your desired reward-to-risk ratio. Now, if you increase the pips you wanted to risk, say 50, you would need to gain 153 pips. By doing this, you're able to bring your reward-to-risk ratio somewhere nearer to your desired 3-to-1. Not so bad anymore, right? Yes. In the real world, reward-to-risk ratios are not set in stone. They must be adjusted depending on the time frame, market environment, and your entry and exit points. A position trader could have a reward-to-risk ratio as high as 10-to-1, while a scalper could go for as little as 0.7-to-1. In summary, risk management. Be the casino, not the gambler. Remember, casinos are just very rich statisticians. It takes money to make money. Everybody knows that. But how much does one need to get started in trading? The answer largely depends on how you're going to approach your new trading business. It varies from person to person. Downtrades are a reality and will happen to you at some point. The more you lose, the harder it is to make it back to your original account size. This is all the more reason that you should do everything you can to protect your account. We hope you've gotten it drilled into your head that you should only risk a small percentage of your account in each trade so you can survive your losing streaks and also avoid a large drawdown of your account. The less you risk in each trade, the less your maximum drawdown will be. The more you lose in your account, the harder it is to make it back to break even. This means you should only trade a small percentage of your account. The smaller is better. Less is more. 2% is recommended. Although it's desirable to trade with a high reward-to-risk ratio, it comes with a drawback. In the real world, reward-to-risk ratios are not set in stone. They must be adjusted depending on the time frame, market environment, and your entry and exit points.